The major averages were split as this holiday-shortened trading week comes to a close, with only the Dow and the Russell closing in the green. Here to share the areas where she's finding opportunity in the current market is Olaolu Aganga, Mercer's U.S. Chief Investment Officer. Olaolu, great to have you here again on a Friday. So setting the scene, technology, arguably kind of expensive, but you're overweight equities. Why?
We're overweight equities. I mean, call it as you may. That's where we're seeing a lot of the growth and opportunities. Now, to your point, valuations in a lot of U.S. sectors, especially technology, is just multi-year highs. There are areas that have been beaten down, as it were. We've talked about real estate for some time. We're seeing that play out also in REITs. So the attractive valuations for us, some of the places that we're looking at, if you were to look outside of U.S. borders, so emerging market ex-China, some of those fundamentals are incredibly appealing. So we're looking there, Japanese equities as well.
Emerging markets ex-China, just across the board, or particular markets?
We've seen India, Korea, Taiwan, some of those other areas.
Let me pause you on India there, because we saw that big reaction initially to the election results there, and then a rebound.
Yep.
Did you take any action there when that happened, or how did you respond?
So we weren't really surprised in the sense that usually when there are elections, there's a lot of uncertainty, initial volatility, but it dissipates. So country by country, of course, you know, we're headed into a major election ourselves. This is a year of big change. So usually during those periods, short spike dissipates. It's par for the course.
We saw something similar in South Africa. But is there a lesson there for investors? Are there opportunities around that region?
So it's not the elections themselves, frankly, that happens. It's the ability for either the policymakers or whoever is in place to be able to enact any kind of long-term decision. So for us, we stay, we watch, and then we see what policies can actually be put into place, similar to what we have here.
So what's really at stake in Europe for investors as we watch what's called the far right, but some are arguing is more centrist than it's been in the past, rising to power in France and flexing elsewhere as well?
So I think back to the point I said, this is a big election year for many countries. So what we're expecting to see, like everybody else, is the uncertainty. Geopolitics has a place in markets, right? You can see all of the different as soon as the different political parties come into play, what policies they interact or what policies they enact, rather, is what could affect long-term growth. So we're just watching a number of these areas.
So you mentioned real estate. The market has come to terms with the idea that there aren't going to be even as many cuts as people had adjusted to a quarter ago. What's the impact on opportunities out there, asset prices?
So the Fed keeping rates on hold, we expected that. Of course, they changed their outlook. So it went from 3 to 1 expected rate cut this year. That was sort of the camp that we were in. For 25, they've taken it from 3 to 4. So we're expecting to see that movement. Now, it is, for rate-sensitive areas, opening up a number of opportunities. We are seeing the rate cut implications really because of inflation and inflation data that's coming and dissipating much lower. If you were to take a step back, though, something that we've been looking at ourselves, not just the rate cuts and inflation, but all of the new segments that we've been talking about are seeing the Fed balancing both inflation and then employment. But if you take a step back, just the average individual is not necessarily seeing that coming through in cost of living, for example.
Well, we were talking about real estate on this program yesterday and talking across retail, industrial, et cetera, not as much residential. Where is the opportunity really, given that office is still a mess beyond Class A? Retail is reliant on a consumer who, at the mid to low end, there's questions about how strong the demand is going to be into the end of the year and what the implications are going to be for rents.
So like everything else, when the valuations in some of these areas are depressed, they are opportunities for us if you can withstand the time holding. So office is a bit more challenging, but warehouse and those types of areas within real estates are actually offering attractive values and valuation.
Are you taking advantage of office opportunities given that?
We have managers that are looking for those types of opportunities to rehab and bring some of those buildings up to some of the newer standards. So even within office, the newer types of developments are still attractive, but it's more of the older buildings.
So rehab and bring up to newer standards, is that more LEED certification? Is it that full redesigns for the flexible work? Is there all of that stuff, all of the above?
I think it's all of the above.
Yeah.
It's all of the above, John, that we're seeing. So just in general, with regards to real estate, like the valuations that we've seen over the last few years has created such a bifurcation, such opportunity. So for us, we're working with managers. This is one of the places that you need to make sure that you have specialists that are in place to be able to sift through that, because some could be valuation traps.